All right. You have a Jackson Dart shirt already?
Gotta support Jackie, baby. Of course.
Do you know we tried to find Justin a Jackson Dart jersey, and they said they're not being shipped until October 30th. Like, they weren't ready for this kid's level of popularity. Like, nobody had any idea, oh shit, we better have 1 million Jackson Dart jerseys ready. So
just get a fake one from China before they slap.
They have the blue one. Oh, I shouldn't say there were no jerseys. They have the blue ones, but he just got the Brian Burns in blue. He doesn't want to have 2 blue Giants jerseys, so he wants the white one. There aren't any. Like, literally.
Okay.
So, it's, listen, we say the market's efficient. It's not always so efficient. Hey, ladies and gentlemen, welcome to an all-new edition of What Are Your Thoughts here on the Compound Network. We are so excited to be here live tonight. The chat is going crazy. You all say hello to my co-host, Mr. Michael Batnick. Michael Batnick, you say hi to the folks. All right.
What's up, folks?
Let's see what's going on in the chat right now. I am told Table for 7 says ready to go to Pound Town. I'm becoming a gold bug. Okay. Maybe we'll talk about that. Some shout outs to Nicole in the chat. Guys, I want to tell you about something. Nicole has officially gotten the Compound's Instagram account as of today to over 50,000 followers, which I think is coming from 1,000 or 10,000 when she joined. So she's 5x the channel in just a couple of years. I think we have a shot of Nicole here being Nicole. Nicole being Nicole. She is literally our resident social media genius and has absolutely helped us transform this channel into more of a movement, I would say, at this point. So shout out to Nicole. We're going to drop a link where you can follow us on Instagram in the live chat on YouTube right now. And for those of you listening, it's the Compound News is the official Compound handle. So there she is. Thanks, Nick. All right. Also wanted to mention we have only, or there might be less by now, only 10 tickets or less left for the New York Live show with Michael, myself, and Jim Cramer. So that's happening on Friday, October 24th. Doors open at 6 p.m. There will be food, drinks. There will be Cramer. There will be signed copies of his new book and a live podcast recording. Nicole, do we have that link? Let's drop that now. If you guys are watching this video later and there are none left, don't say I didn't try. Don't say I didn't try. I really hope that whomever wants that ticket sees this alert. And she's saying less than 10. All right, we're on fire. Sponsors tonight, FM Investments. Michael, take us through FM Investments.
All right, listen up, folks. Even after the Fed's recent modest cut to overnight rates, compelling bond yields are still attracting a lot of investors. That's right, 90 billion, 98 billion in September. Wild. Most bond funds come with a catch, which is those regular income distributions that bond funds have to pay out. Distributions sound nice, obviously in theory, but they actually weaken the magic of compounding. Why? Because every ETF distribution...
Why do distributions weaken the magic of compounding?
Taxes!
Oh, shit.
Taxes. That's it.
Every ETF distribution pulls assets out of the market.
Shut up for a second. Let me finish this.
Temporarily. It says verbatim.
So, the FM compounder ETFs are designed to solve the fixed income distribution problem. Compounder ETFs can help investors avoid distributions, stay invested, and compound their capital gains. What are the compounder ETF tickers? I'm glad you asked, Josh. It's CPAG, that's CPAG, the FM compounder US aggregate bond ETF, and CPHY, the FM compounder high yield ETF. CPAG and CPHY help investors harness the magic of compounding. Learn more about the FM compounder ETFs at fminvest.com.
Shout out at fminvest.com. That is a real problem, and it's nice to see somebody finally address it. All right, we have some...
you just shouted out their website. Unbelievable.
Yeah, well, listen.
Yeah, shout out to the website.
Shout out to the site. We got some peeps in the live chat tonight. I want to say hello. In Jensen we trust. Cam Rackham. Matthew Stevick is here. Oliver's here. Joe Altamoro, we see you. Jay Luther, what's up, man? Ring. KPS, Fred, C-Note, Connor McLaughlin, what's up? Georgie, All right. Thank you guys for being here for the live. Let's get down to business. First things first, the banks reported, some of the largest financial companies in the world reported earnings this morning, and the reports were awesome. Now, I don't think that's surprising to most people. Financials have been among the top 3 or 4 sectors of the year pretty much all year, and the big banks are among the best of the financial sector stocks. So no one was really like totally knocked out that these reports were so good. But I think it just underscores the broadness of the rally, because the banks don't just deal with technology companies. The banks have customers in every segment of the economy. What do you think of that?
That's right.
What do you think of that take? Like banks as a gauge of the economy beyond tech. I know they're involved with tech as well.
Yeah. So JC was on the show earlier in the year. And if you'd listen to me for a second, I'll let you know that, yes, banks are important to the economy, to the stock market. It's discouraging when you see the banks being left behind. You want to see real confirmation that there is activity in the real economy outside of just this circular notion of OpenAI and Salesforce now, which was a dud, and Oracle and all of these deals. You need the real economy, damn it. Yes. So I just before we get into the reports today and the market's reaction, I wanted to highlight Adam Parker's work. Adam did this really interesting thing showing what you want to pay attention to in terms of stocks before earnings. So chart on, please. Adam said stocks in the bottom half of industry group relative momentum. All right, so stocks in the bottom half tend to beat expectations on the earnings release. And those in the highest 5% of 2-week stock performance see a statistically significant underperformance on the day that they report earnings. This is important. On average, big moves into earnings releases should be sold and big laggers should be bought. So let's see what happened today with Citigroup and with Wells Fargo. Next 2 charts, please. Both of these acting pretty damn heavy. Not necessarily if you were just purely technicals. I don't know that I want to be long this going to earnings. Boom. Big candle. Next one. Same thing with Citi. Also, pretty cruddy price action. And yet a very nice day today. So kudos to Adam. I thought that was interesting stuff.
I only agree with half of that.
Which part?
I guess it's the on average part that I don't love, because think about, like,
yeah, it's on average.
I know. But think about anecdotally, like how many counter examples of this that are so easy to find at your fingertips.
Dude, of course. He's all,
because
so put his chart back on, put the bar chart back on. So this is showing you pretty clearly that the stocks with the strongest momentum. Now, listen, this is very short-term stuff. We're talking the next day. The stocks that are ripping into earnings, like they tend to, the expectations are too high in the short term. And stocks
is that percentage gain?
Yeah.
On the left?
I don't know if this percentage gain. It's a T-stat. Don't worry about what T-stat means. It's very technical.
Because the point is, it's what this is not this. So what this is not saying, chart off. What this is not saying is that stocks rallying to earnings have bad earnings results.
No,
it's just describing profit taking, selling the news.
Correct. That's it.
You're
such a hater. What's wrong with you? It's a great chart. It's a great chart.
I think it's good food for thought, but I want to see, what is that, the next day?
Yeah.
I kind of want to see, give me the total return the 2 weeks before the earnings and the 1 week after. And I guarantee you that stat gets obliterated. Like, how many people are buying the stock the day before earnings and selling it the day after? That's a very small component of the market that does that.
His clients are hedge funds. I'm merely making the point. That's it. All right, so let's get to the banks.
I do understand the point. I just question the practicality of paying attention to it. Is that...
There's a lot of things that we talk about that people should not pay attention to. Let's be honest.
That's definitely true. All right. Earnings. So we have a bunch of great stuff here from the gang. Callie, Chart Kid, Matt, Sean. I don't know whose is whose, but these are some things that we want to share. This is the financial sector earnings week. Not every one of them reports, but almost every big company that reports this week is a financial. 65% of the companies reporting this week are from the XLF.
I love this week.
Sector. Okay. Me too. And I love that it's first, by the way. I think that's huge. Okay.
Same.
The entire financial sector is expected to have growth of 13.2% for the quarter. That is
Healthy.
the fourth highest within the S&P 500, fourth of 11. Not all of these stocks, even though they all had good earnings, not all of them went up after. Again, Adam's right. That phenomenon is real. A lot of these are stocks that have run up 20% into these reports. So I get it. Okay. Trading and investment banking revenues beat and look strong across the board. Deal making is okay. I think deals were the big story at Goldman Sachs, or overall investment banking revenue, I should say. Worries about credit quality are, I don't know, they're not new. I feel like it's every quarter. People are like dying to find some sign of it.
Dude, there's nothing there. There's nothing
there. JP Morgan, the provision for credit losses was $59 million, driven by the impact of a charge-off related to a single client, which we'll get to later. Net charge-offs were $62 million, and the net reserve release was $3 million. They asked about the credit card business early, or they didn't even, before they were even asked about it, on the JP Morgan call, they just went right to it. CCB, there's nothing happening there. There's like literally nothing to report. There's no uptick. There's no like scary activity in the worst borrowers, like none of it. So that's the good news. Jamie Dimon's economic comments were, the usual. He is never going to give you what you want if what you want is everything's great. That's not Jamie-esque. He sees himself as a risk manager, not as a cheerleader.
Well, hold on. Let me read this quote. So this is slide 1 in their earnings release. While there have been some signs of a softening, particularly in job growth, the U.S. economy generally remained resilient. However, there continues to be a heightened degree of uncertainty stemming from complex geopolitical conditions, tariffs and trade uncertainty, elevated asset prices, and the risk of sticky inflation. As always, we hope for the best, but these complex forces reinforce why we prepared the firm for a wide range of scenarios. He says this every quarter. It is who he is, and he shouldn't say anything different. He's the head of the biggest bank in the country, in the world.
Right. Somebody was joking around. I forget who it was. Like, what would get you bearish?
He'll never spike the football.
Is Jamie Dimon taking a victory lap? Like,
he never will.
All right, we're good.
He never will.
Made it. Okay. Citi. Anything crazy to say on Citi? Not really, right?
So, you know what? I'll be honest. Citi and Wells, I can't listen to them all. I do BlackRock, I do Goldman, and I do JP Morgan.
I only did BlackRock and JP Morgan today. And Goldman I read about. Citi beat on revenue for all divisions and didn't really have any negative comments on the economy. I saw they put somebody on TV today, and he echoed a lot of what Jamie Dimon had to say about overall credit quality and lending and et cetera, et cetera.
They basically all say the same thing.
It's business as usual, though, is I think the takeaway. Wells Fargo got out of bank jail. So for a long time, because it was the worst run bank in America, run large bank in America, literally lying, cheating, and stealing, they had a cap on how much money they could return to shareholders. They were shut out from doing any kind of M&A. They were like in a penalty box, deserved. They faked 40,000 fake accounts at the retail bank branch level. Everyone running the firm has been fired as a result. New management. They have this guy, Charlie Scharf, now for the last couple of years as the new CEO. He is a Jamie Dimon protege. People seem really happy with the turnaround at Wells Fargo. And now they have this asset cap lifted. So the third quarter was the first full quarter without that cap. So they're going to be treated like every other systematically important financial institution or SIFI. And they should be able to do bigger buybacks, dividends, et cetera now. This was a good reaction, though, Mike, on Wells.
Yeah, well, because nobody expects anything from them.
Yeah. The team notes that's the best earnings performance, best post-earnings performance since 2015. Stock hasn't done this in response to an earnings report in a decade, which I find notable. All right. J.P. Morgan, Goldman both went down, or underperformed the KBW Bank Index. Let's put that chart up.
Goldman was down 2%. Goldman and J.P. Morgan both down 2% on the day.
This is market caps. Look at J.P. Morgan acting like a Mag 7, almost $1 trillion, $846 billion. Goldman is $238 billion. BlackRock $178 billion. Are you surprised by the order?
That's a good question.
Between Goldman and BlackRock, if I blindfolded you, which would you have guessed is bigger by market cap right now?
I probably would have guessed BlackRock.
That's what I think. I would have guessed that too. We would have been wrong. Although they're close enough that like a month of market performance could change that. Next chart.
Hold on, just for a second. We spoke about this with Scott Nations. Man, I know Robinhood is killing it and their future is bright, but 120 billion, just in the context of BlackRock being 100, what do we say, 180? One of those is wrong.
Oh, why is Robinhood almost the same valuation as BlackRock?
One of those is wrong. Very wrong. Come on.
I pitched BlackRock on CNBC today. Pull up
today.
Pull up a technical chart though. This is a legit breakout. Like a highly legit breakout.
So it closed at an all-time high today. BlackRock took in $205 billion in quarterly net inflows. $205 billion. How much is on Robinhood's platform? Is it that much? Does Robin have 300 billion? What's the number? Whatever. It's close.
It's in the billions is the point. And BlackRock's at 13.5 trillion.
BlackRock took in, and I know they're different businesses, but BlackRock took in $200 billion in quarterly net inflows.
Oh, I had some notes from JP. Could we just go back to JP Morgan?
Yeah.
All right. So the consumer is fine was my big takeaway. They said it 50 different ways. And they would love to tell you if that's not the case. They'd love to be the first bank to say, yeah, no, there's a real problem here because they're going to handle it better than everyone else. Yeah, they'll tell you.
So Jeremy, the CFO said, Jamie may have his own personal opinions here, but I think at a high level, the story that we're trying to tell is one that's anchored on the current facts. The current facts on the consumer side are that the consumer is resilient, spending is strong, and delinquency rates are actually coming in below expectations. Those are facts that we really can't escape.
People keep as if it's a bad thing to say. It's crazy. Which I'm going to ask you a question about. The net interest income outlook for 2026, which is the bulk of the revenue. It's a bank after all. They said the consensus estimate on Wall Street of $100 billion for 2026, quote, does look a bit low. So this bank could conceivably exceed $100 billion in net interest, just given the size of its deposit base, which is really, really, really remarkable. Then two different analysts wanted to talk about First Brands, which I know we're gonna dive into in a minute. But I just wanted to point out to people. So JP Morgan has minimal exposure to First Brands, although not zero. But they do have exposure to this thing called Tricolor, which we talked about this last week, how that's being talked about as the next disaster. It's another auto-related business. But they kept saying NBFI. And I had to Google it because I forgot. It's been a really long time since we heard analysts on a call asking about this. But non-bank financial institutions, NBFI is going to be the buzzword of the fourth quarter in the financial world, I believe. That's my top pick for like top buzzword that people start writing articles with that in the headline. I think it's going to be like just because there is a huge contingent of people who want things to go wrong, especially for hedge fund managers and private equity people,
and especially the Financial Times.
Oh yeah, the FT would love to see this all blow up. But I think this is the new buzzword that people are going to walk around saying because they think it makes them sound sophisticated. Jamie kind of said he thinks the news gets worse or there are more revelations.
No, he did not say
but he
that.
doesn't think it's like.
Hold on, he did not say the news
catastrophic.
gets worse. He did not say the
did.
news gets worse. No,
right,
he
read
did
his quote.
not.
Read his quote.
Dude, he did not. First of all, this is from Jeremy. So Jeremy said, we've also acknowledged that a lot of the private credit actors are, large, very sophisticated, very good at credit underwriting. I don't think you're supposed to jump to the conclusion that there are necessarily lower standards or a huge systemic problem. To the extent that we lend to some of these folks who are client of ours as well as competitors of ours, that lending follows our normal practices. It's often highly secured, and everything we do is one way or the other or another risky. I'm not sure that our lending to the NBFI community is an area of risk that we see as more elevated than other areas of risk. And the quote that you're mentioning about Jamie said something like, I probably shouldn't. No. He didn't say that. He said, I probably shouldn't say this. And I'm guessing because he doesn't want to scare people, but there's never one cockroach in the kitchen. That's what he said.
Okay, yeah. So that's not the same thing as I'm saying?
No, more to come.
How is there a big difference? Wait, how did your voice just go up 6 octaves? Yes, more to come. There's never one cockroach. How are these two?
Those are not the same thing.
How are these two turns of phrases not synonymous?
Okay, because there's never one cockroach in the kitchen is saying.
What's the implication of that? That there's another cockroach. More to come.
No. But it's not the same.
Stop.
It is not the same.
Please stop for my benefit.
There is more to come is saying that there's never one cockroach is like, wouldn't be surprised if something else happens. There's a difference.
Sure, Michael. Let's do
There's
Goldman. All right, let's do Goldman.
So Goldman, it was the same questions on the call, and DJ Solly, he might draft my playlist because it's never interesting.
No,
I think I'm done with Goldman.
On purpose, do you think?
I don't know. He's just there's respectfully, there's just not that level of charisma, and he doesn't say anything interesting. Maybe nor should he, but
I think that's I really think that's by design. I don't think he wants any more attention personally. Like I don't.
He came through. Credit to him. He did come through. There was 2 years ago. It was pretty dark. So they were asked the same questions about private assets, private credit, risks, etc. And nothing. I listened, nothing to pull out. But the big story for Goldman, and to the point that we opened the show with, is that the economy is firing. There is deals. There is activity. So throw this chart up. Look at investment banking fees. Second quarter was $2.1 billion. Third quarter, $2.6 billion, up from $1.9 billion in the third quarter of 2024, year over year. I mean, it's humming. It's definitely cooking. Things are happening.
That's a meaty bar right there.
Things are happening. Yeah. Goldman bought Industry Ventures, which is interesting. $8 billion venture company.
What is that?
Plays in the. So
it's just a venture capital fund, or it's more than that.
They do a lot of different things. They were the pioneers of venture secondaries, and they've had a very successful storied career. $8 billion in AUM and on the platform. I think the cash comp was like 600 with another 300 on the earnout, something like that. So
it's almost $1 billion for the business. Do you think that was a situation where the company put itself up for sale and Goldman won an auction?
I doubt it.
Or do you think this was strategic and Goldman went to them and said, "There's a good fit here for some for some reason beyond just
So not knowing anything, speculating tourist here, I would say that this company is very well respected. I would guess that they're not hiring a bank to shop them. I would guess that Goldman approached them.
Well, there's never just one cockroach, so I wouldn't be surprised to see more deals for these companies now that they sort of can do whatever they want, almost whatever they want. I think from a regulatory standpoint, from an antitrust perspective, if they want to do something, they could probably do it. So I think we'll see more. Let's just on BlackRock. I know you have some data on this one. This is what stood out. This is what stood out for me. $13.5 trillion in AUM is so big.
Yeah,
like we say the words trillion a lot on the show because we're always talking about like Apple and Nvidia. But like honestly,
okay, I'm so
glad
you
mentioned that. An investment firm with $13.5 trillion under management. This is one company managing $13.5 trillion, not just managing, but like responsible for. That is so big.
Okay, I'm really glad you mentioned that because show this chart from Bloomberg Intelligence, John, please. So IBIT took in $100 billion in about 400 something days.
Oh my God.
Okay, so IBIT and their other ETFs total did $61 million in crypto ETF revenue. So I call it a $250 million annual run rate, give or take. $250 million. And guess what the percentage of that revenue was? 1%.
Oh my God. Wait, can we put that chart back up? This is showing how many days it took for IBIT to get to 100 billion. And they have 4 other ETFs that are 100 billion. VOO, which
No,
is
that's not what this is showing. This is showing how quickly it took other companies, other ETFs to get to $100 billion.
Yeah, that's
so
what I said.
VOO. No,
That's what I said.
You said
these are all BlackRock products.
No,
no, they're not.
Dude.
VOO and VEA are Vanguard.
Yeah.
IEFA is State Street, and IEMG is
No. Those are BlackRock.
that's
IEFA and
Black.
IEMG, those are BlackRock.
Oh, okay. So, but I'm saying that's the length of time by days
That's
is
what
how
I'm
long
saying.
it took. Right. So IBIT did it in just over a year, and VOO, which is like is like the Vanguard SPY, basically
Yep, correct.
took 2,000 days. That's what the point I'm trying to make. Okay. What is it? What does that say? Does that say more about Bitcoin, or does that say more about just the development of the ETF business in general?
Yeah, both. In fairness, obviously ETFs are a lot more mature than they were when VOO was launched, back in the day. So, but my big point is this: show the table of business results. So look at September. Look at the fourth column. September 30th, AUM as a percent of total.
Okay.
Digital assets, 1%,
Oh yeah.
and
Like,
1% of
doesn't exist.
fees. It's like a blip, and it's $100 billion product, and it's a blip. Go back.
Sorry, I have another
what?
question. I have a question on that though. So only 1% of BlackRock's AUM is in digital assets. Let's say IBIT.
And base fees.
But how big is BlackRock in Bitcoin overall? Are they 10%?
Like how much of Bitcoin does
Well, if
is in the BlackRock
IBIT is
ETF?
100 billion, how much Bitcoin is there?
And Bitcoin's what? Is it 3 trillion? I don't even know what it is.
I don't know the
3
answer,
trillion,
but
4
they're
trillion?
they're like a meaningful
Yeah.
amount and rapidly becoming more meaningful.
Yeah. All right, chart back on. The other portion that's interesting is private markets, $300 billion plus, and it's 13% of the revenue, and that number will grow higher, undoubtedly.
Yeah. Yeah, for sure.
Anyway,
And
the point is-
it's super profitable. Even
Josh, you're right.
Even though there's 12 or more digital asset ETFs, none of them are cutting fees. Like all of them are making money.
Bitwise is.
Oh,
But my
Bitwise
point
cutting
is-
fees already? Okay.
I think they are. But the point is this: trillions of dollars, to your point earlier. It's so much money that showing that the $100 billion ETF is 1% of their AUM, 1% of revenue really puts it into context. It's so much money. So like getting back to what I said earlier, BlackRock is either way undervalued or Robinhood is way overvalued, and maybe a little bit of both.
All right. Story today in the Wall Street Journal, mid-morning, reacting to these earnings reports that we're talking about. Can we get a screen grab of this, John? Wall Street is firing on all cylinders, fueled by deals and trading. The subhead is results are beating expectations across the big banks. So not to repeat a lot of what we just said, but here are some things from here. Goldman is now on pace for its best year ever. Ever. Did you hear that? In its main investment banking and markets division. JP Morgan is on track to make over $50 billion in annual profit for the second year in a row. BlackRock, $13.5 trillion. These are the most important companies on Wall Street, and all of them are just absolutely crushing it. This year, we've already had the biggest ever leveraged buyout. That's Electronic Arts. Advised by Goldman Sachs, $20 billion in financing from JP Morgan. Bank of America is expected to bring in the biggest ever disclosed deal fee for a single bank, $130 million. So did you hear what I said? Bank of America is getting $130 million for that deal. JP Morgan is financing it with $20 billion, and either the buyer or the seller was the seller was advised by Goldman. It's unbelievable how much money is being made, which explains why these stocks have done so well. So, and they go on and on. There's equity trading, there's equity underwriting, there's debt capital markets activity. Just it's all explosive, and it's all on a year-over-year basis. Just a huge change. So the question I wanted to ask you is, one thing that's really interesting, we're kind of like in these Goldilocks days for Wall Street, with all these records being broken, but it seems like everybody wants to spend the entire time imagining ways for it to all come crashing down rather than just like enjoying it. Like, all right, we're in it right now. Why do we have to focus relentlessly on how it's going to end? Do you get that feeling that that's all anyone wants to talk about?
All right, the question is, who's anyone? Because I think what you're referring to are the headlines, and I was talking to Ben today about this. Journalists don't, and this is not their fault. Good news is boring as shit. Nobody cares. And
I mean, this is good news, but this is an exciting article.
But
it's a
no,
big
it's not.
flashy
Good,
headline.
Dude, come
Wall
on. So you know what I'm
Street's
talking about.
firing on all cylinders?
Not interesting. They want more First Brands stories. That's interesting. How could people have been so irresponsible? People with so much money, how could they have been so reckless? That's what people click on. Nobody cares that Goldman's going to have a record year. Like, investors care as well. They should. It's the second biggest sector in the economy or in the stock market. But this idea that people want to see the banks blow up or whatever, Big Short 2.0, yeah, that's what the headlines want you to see. Of course they do. They want you to, that's their business.
But how do you explain the amount of regular people who are doing Google searches for stock market bubble? Everyone's saying bubble now. Everyone. Is it because things are just so good that people just can't take it and they just have to ask, like, when is this going to come to an end?
I mean, that's a different story. The stock market bubble and the banks doing well, those are different stories.
Not really. I think they're pretty related. I don't hear anyone, regular people or the media, being like, yeah, it's a bull market, things are good. It's a bull market, but it's weird. Like I don't understand this obsession with how's it going to end.
Well, I love that, and
when's
so
it
should
going
you.
to end? How's it going to end?
Dude, we need a wall of worry. We can't have everybody's like, everybody in the boat, no risk, whatever. S&P 15,000, get in, moron. We're getting rich. Like, I'm happy that there's but.
Yeah. Well, there's a lot. I want to show you something funny. Put this first tweet up. This is a good tweet.
Yeah.
Nathaniel Whitmore. Do you know him? I don't know. I don't know him. An entire generation watched The Big Short, thought Michael Burry was cool, and spent the next decade calling everything a bubble. I didn't like this because I'm not on Twitter, but I would have liked this 500 times if I could. This is, I think, one of the best explanations for all of the hate and bitterness about the stock market. I think a lot of it boils down to all these ambitious young men who saw that film in their teens or 20s, or God forbid, read the book a little bit earlier than that, and just they thought, like, this is what you're supposed to do. You're supposed to be the smartest person.
Find the fraud.
You're supposed to be the smartest person in the world, outsmart everyone, spot the bubble before everyone else, bet against it, and like that's like what you're supposed to do in the market. That's like literally what 100 million people think they're supposed to be doing. And
yeah.
I'm exaggerating the numbers, but like there is this whole generation. They think that shit is cool, being like this freakishly like brilliant contrarian who makes everybody else look like a moron.
Now, I think a lot of these people that you're describing are people that wanted to be professional investors, like real serious investors. I think most average people don't aspire to be Michael Burry. I think a lot of people grew out of that shit. Like our friend Dan McMurtry is killing it in the hedge fund business, and he's not one of these freaks that is betting on the world and that everything's a fraud. Like I think that there is a corner of the universe, absolutely, that was brainwormed by this, but not everyone.
I like brainwormed, but like I think I think they want to be the hero. I don't think they're like villainous. I almost like they want to be the guy that saves everyone.
Well, you know why?
Because they're like, that's about to blow up.
Yeah, and I'm going to save you. So Michael Steinhardt famously said, nothing makes a money manager feel better than making their clients money when everybody else is losing theirs. You are hero goated forever and ever. There's no higher mountain for a money manager than that. And so bull markets make that sort of investing really difficult, obviously.
This was a good clapback from High Yield Harry. This is one of the top 5 funniest people in the world in finance. He's pseudonymous. I don't know him in person. He said, "Disagree. I was inspired by these guys." These are the mortgage brokers in The Big Short, right? Who would beyond ridiculous, like caricatures of. I know mortgage brokers, and directionally, the movie sort of had it right, but like they were like to the nth degree. I thought that was good. Anyway, it's kind of sad that there aren't a lot of people who are just like, yeah, this is pretty great. Like my friends who work on Wall Street are doing well. They're making money. They're buying bigger cars. They're buying bigger homes. Okay, maybe a little bit of envy, but overall, it's a good thing that the capital markets are working. That like nobody has that opinion.
I don't know. I think people in the real world might have that opinion. Like people on Wall Street in the real world might have that opinion. I think that all forms of media consumption, social or otherwise, just warp everything. I really do.
I do too. All right, let's move on.
Okay, so I saw this poster. I think Robin actually shared this with me. Throw this Lulu thing out. All right, so The Economist, famously late and the poster child of a lot of magazine indicators, which I don't believe in, but sometimes.
I was going to say this might be the bottom for Lulu.
But sometimes. So I immediately wanted to buy the stock. So I thought I'd play a game with you, Josh, where we're going, okay, value or value trap. And we're going to start with Lulu. So, and I told Sean, we're going to revisit this in a year, okay? So Lulu is in a 67% drawdown. So this is obviously surface level analysis, right? We're not going deep on each of these names. So chart on, please. We'll start with Lulu. So on top, you see the price. Lulu is down 67% from its high. In the middle, we've got the free cash flow. And on the bottom, we've got the PE ratio. And I got to be honest, so the free cash flow is obviously turning, like, duh. It's, stocks don't fall 67% for no reason. I thought it would have been way worse.
I think I think it's a buy if my only two choices are buy or sell. But I don't invest this way personally. I'm not a value guy. And in fashion, it's even twice as hard. So in other words, one thing to be a value investor and look at like Hershey and be like, all right, this company's been around for 380 years. I'll take the bet that whatever's going wrong, they'll fix it, and there will still be an underlying demand for chocolate. I don't know that anyone can say that about any fashion brand. And some go away forever. That being said, there are some really great examples, and I'm sure they're a minority of the time, of brand resurrections. And what we witnessed,
Crocs.
Just think a couple of months ago, all it took was Sydney Sweeney and Abercrombie and what is it?
American Eagle.
I don't even know. American
Crocs
Eagle. They're all the same to me.
No, you're right. So retail companies turn around, but it is hard as shit. So
it's hard, dude.
As much as I really want to fade The Economist and just hold my nose and buy, I think you're right. Like Aloe is just destroying them. So maybe they get it together, maybe they don't. All right, so it sounds like we're both pretty skeptical.
Just get Sydney Sweeney wearing Lululemon yoga pants. Why is this so difficult? You can't write a big enough check? Close 10 stores and give her the money. And next question. Was the question, how do I turn around Lululemon?
All right, Salesforce.
Cassie. Okay.
Salesforce. So interestingly, the stock is down 35%. Free cash flow is near an all-time high. Forward PE is about as low as it's been for the last couple of years, and nobody wants any part of the stock. In fact, it failed to rally on the news today that there's a partnership with OpenAI. I mean, nobody wants to own the stock right now.
I think that there's an open question about the need for buying seats per employee head on a go-forward basis. I think every SaaS company will be facing this reality in the AI age. Companies are writing their own software at this point with the aid of AI to enable them to do a lot of the things that you needed to rely on Salesforce for. That's A. B, yes, we're in a low hiring, low firing equilibrium. That's going to break in one direction or the other. And I think most people would bet it's going to break negatively. and you will eventually see layoffs. Doesn't have to be catastrophic, but companies like Salesforce that rely on enterprise sales, those are per head deals. And if you have a lower head count working in corporate America, it stands to reason it's going to be very hard to sell. It's very hard to grow an enterprise SaaS business that, quite frankly, already has everybody as a customer. Where are they going next? So
enough of this. Value trap. I have 2 more names. What do you think?
Trap. It's going lower.
Trap.
I don't want it.
Okay. Nike. We've spoken about the stock a million times. Down 62%. Holy shit.
Close your eyes and buy it. Just buy it. I'm going to buy this. I'm going to violate my own rules. Just close your. All right. Here's what you do. Buy 500 shares now. 500. Have 500 shares in reserve for when it has a false breakdown and breaks below 55, and it'll last for 10 seconds. You need to use a buy stop limit in that moment. But I am telling you, when it breaks below 55, you put in a buy stop limit for 60 and just ride it back higher. And I don't know. I could see this could go to 95 in 2 weeks if they get the right headline, the right news flow. The reality is it's just not that bad. It's bad.
The counterpoint is it's 35 times earnings.
Counterpoint, nobody gives a fuck.
I agree.
You want to hear how many times earnings Palantir sells for?
Yeah.
Come on.
Well,
what are we doing here?
What are we doing here? But point taken. All right. Chipotle. I actually think I want to buy the stock. So Chipotle is in a 38% drawdown. Its free cash flow is near an all-time high. The stock is always expensive, so forget about that. But nobody wants it. I think a lot of this is the CEO leaving, and there was problems, no doubt. The food got ridiculously expensive. But I'd be a buyer of this stock.
You know what I think about whenever I walk into a Chipotle, usually to pick up food from my 16-year-old? I feel like the kid in the Emperor's New Clothes. Am I the only person willing to say out loud the food is terrible?
No, it's not.
It's literally terrible. Why?
No, it's not.
Why am I the only person who will admit it? And so now it's expensive and terrible.
I've seen you eat Chipotle.
I know I do. Do I look very selective?
Come on. Dude, Chipotle is a great lunch food. What are you talking about?
No, it's not. It's convenient and it's nearby everywhere and it's fast
and it tastes good and
it's slop. And I have to be honest with you.
All Mexican food is slop.
Nope. And it's getting worse. Would you like to apologize to the Mexican community? This is just not good food.
I love slop.
No, it's not good food. It's not good. I want it to be. Because, Mike, I have to go there for nugget every 3 days. That's all these kids eat. That's all they eat. Gen Z and millennials, they'll eat Chipotle 7 days a week. I do like Chipotle. I just don't understand why people won't say it used to be better than it is now. I've been to, let's say, Chipotle's in 5 different states in the last 2 years. Okay? It's never good anywhere I go, but it used to be.
I enjoy it. We have one more. Okay, last one.
What do you get? Salad?
2 more.
You got a bowl? A bowl?
Don't worry about what I get. I get what I get.
It's not good.
All right, Airbnb. I like this one too. All right, this is a great story. So Airbnb, the problem here is it came public in a mania, and the valuation was ridiculous. But it never stopped growing its free cash flow, and the stock has gone sideways for 3 years. I think this is a buy.
I don't want to dislike all of these. What did I say I like so far? Lulu and Nike?
Nike. No, you don't like Lulu. You said no Lulu. You said if Sydney Sweeney's in Lulu. You don't like Nike.
Yeah, no, I think it's turnable. Yeah, so I only like Nike out of these.
Okay.
I don't like this one either. Well,
okay.
I never liked it. I never understood it.
Because you personally don't like it because you don't like Chipotle.
So I have a bias.
This is Josh is a snob episode. All right, last one. All right.
I don't like the stock. I think it's too much competition in lodging.
Okay. Fair enough. All right. Adobe. This is like a value the value people won't stop talking about this one. So free cash flow, all-time high. Stock is in a 50% drawdown. So stock's been cut in half because nobody believes the earnings. Nobody believes the earnings are going to be there.
What's the valuation?
21 times.
It's a buy.
I mean, knowing nothing, it looks like a buy.
No, I'm looking at the chart. I don't care about the value. I was joking. It's a buy.
There's a lot of support here.
It's a buy with a very obvious place to put a stop. Like
I think your stop is your buy. Where your stop is, you buy it. Don't put a stop in.
Mike,
Be a man.
Mike, the April low was tested 3 times. This is the third test of the April low, which is 330.
But it's right there.
I understand. I think it's gonna break below, and it'll be a false breakdown, and then you plow into it when it reverses.
I agree.
I love this setup. I love it. I love it.
This will be 450 in a year.
So the reason why this stock's not doing well is obviously like the business isn't growing, but everyone thinks Sora and ChatGPT and all these services are going to obviate the need for professionals with Adobe licenses doing design work. I would go the other way. Most of the people doing their own childish AI slop design work are doing these like cartoon images of themselves that's not going to pass for design. The world
my mouth
craves
just
beauty.
watered. My mouth just watered. I'm thinking about Chipotle. I might get a bowl for dinner.
Like voluntarily, not because it's convenient.
I do love me some Chipotle.
Do you, bro? All right. All right. This is a good game. I like it. Was that the last one?
That's it. We're done.
All right. So I like Adobe. I don't know if I have the guts to do it myself, but I think it's trying to bottom right here. Okay. Jerome Powell spoke today. Did the market really react or not really? I couldn't tell. I didn't see like big signs of a big reaction.
While he was talking, I don't even know what time he spoke. I think the market reacted intraday to the Trump tweet.
All right. Callie points out the new thing that he said was that balance sheet runoff could end in the coming months. So what that means is that the tightening might be too much tightening. Balance sheet runoff is bonds mature, and then the Fed does not go out and buy new bonds to replace them, which is right. Like that's like the end of the runoff. So
remember, the bull market was only being supported by Fed liquidity,
by the Fed like replacing bonds that were maturing and buying. So I don't know. I thought that was an interesting comment. I don't. Callie points out yields didn't move much on this, maybe a few basis points down. Okay. Job market employment prospects continue to worsen, although conditions haven't changed much since the September meeting. Good nugget. Let me see what else. Callie points out inflation increased year over year for a third straight month in August. So that's looking at CPI, PCE. Here was her. By the way, Callie's our chief strategist at Ritholtz Wealth. That's why we're citing her.
Read what you wrote to Reuters.
Jay Powell dropped a major piece of news when he mentioned that the Fed could stop culling the size of its balance sheet in the coming months. The Fed has been reducing its runoff for months now, but the idea of a stable balance sheet could help lower yields in the middle to long part of the curve, meaning that's where the Fed would be buying bonds.
That's important.
Thus lowering yields. Yes. That's a hidden source of relief, especially to homeowners, that the rate cuts alone may not be able to deliver. Okay. I think that's really interesting. Otherwise, Powell didn't say anything too surprising. He repeated the no risk-free path comment, which I'm guessing will be a buzzy monetary policy phrase for the rest of the year. Both sides of the Fed's mandate are still under threat, even though Powell and co. have chosen to focus on unemployment. Inflation worries still linger. All right. I think at this point in time, the Fed as a chess piece for the stock market is off the board. What do you think?
I agree with you. I don't think that whatever the Fed does at the next couple of meetings, I don't think it's going to have a big impact on the stock market.
Cut or not cut, I don't think it matters that much. It might matter in the moment, but I just don't think it matters for where the market ends the year. I think they're off the board.
I am curious to hear what companies have to say, especially consumer-facing companies, about the impact of tariffs on spending and margins.
All right, let's do this first brands thing. I know we covered it last week. What do we want to say about this?
Here's what I want to say. All right, first of all, throw this graphic up. So for people who are not aware of who First Brands is, they are a conglomeration of all these auto parts. The only one that I know, frankly, is Michelin.
You and I, just for the listener who can't see us, Michael and I are not the kind of guys that know how to fix anything on a car. We don't lift the hood up for any reason. We don't change tires. We don't do any car stuff. So these brands mean nothing to me. I honestly have never heard of any of it. What have you heard of on this?
Michelin.
They don't own Michelin. This is important. They license Michelin, just the windshield wipers.
Okay.
Yeah, they don't own the Michelin brand.
Okay.
And I only know Michelin because of the restaurant ratings. Go on.
All right. So we spoke earlier about NFBIs. NFBIs, and one of the things that Jamie mentioned was fraud. He used the word fraud. Mm-hmm. That this is even though there is not one cockroach, this was fraud. So Bloomberg did a story. So this guy, Patrick James, built a company, 26,000 employees, 6 continents, revenue of $5 billion. But a lot of it was just buying up companies. So debt and very little organic growth. So in 2023 to 24, its revenue only rose 1.3%. The cost of servicing its debt went up 38%. Not great.
Is that bad?
Not great, obviously. So Jefferies had a hedge fund, Point Bonita Capital, that had a quarter of one of its portfolios, $715 million in First Brands, which is very bizarre. I'll get to that in a sec. Look at this chart of Jefferies. Smoked. Not great. Not great. Why would a hedge fund have a quarter of its money in, I think, the debt of a company? All you can do is get paid back. Why would you make a concentrated bet on debt? It's very bizarre. But so the article goes on to say that in 2011, a unit of Fortress Investment Group sued some of the companies and claimed that they had obscured the CEO's controlling interests, and the fact that all the companies share the same employees and management, do not have separate books and records, and are grossly undercapitalized. This guy denied the accusations, but he paid to settle the case. And another one that was alleged fraud 2 years earlier. Public records showed that he took out mortgages for homes in Cleveland, set up a foundation to give churches and schools in the area money, but he left almost no trace of any of this on the internet. So there's all sorts of red flags all over the place.
What the hell?
This guy took massive steps to obscure all traces, so you couldn't find anything about this guy on the internet. So one of the analysts said, it seems like he went above and beyond to hide himself and his assets. All of this should be a huge red flag for investors. So I don't know who missed this, how they missed it, whatever. But the point is there was allegedly fraud going on. And Larry said, talking about private credit, the market is growing increasingly anxious given some of the recent dynamics, both related to perhaps growth, blah, blah, blah. So Larry said, all right, thanks, Alex. I hope you're doing okay. So listen, I'd start by saying just that the heritage of BlackRock and HPS, and definitely the combined firms, steeped in rigorous, okay. So we're talking a lot with teams about the news, but I'd say that teams are generally seeing strong credit quality from borrowers. They're generally seeing a positive environment from credit investing, even in syndicated loan markets. Default rates have been declining. We, of course, read the same headlines that you do around private credit, bankruptcies, but those exposures are actually in syndicated bank loans and CLO markets. They're not with large private credit managers and direct lending books. And in those very public cases, the ones that we're reading about, you're reading about, potential frauds also been reported. So anyway, listen, BlackRock is obviously, they're all in on this. So what do you expect them to say? But is there another cockroach? Perhaps. Would it be surprising if this blows over as an isolated incident? Not for me.
All right. I actually think it's good that this is happening because I do think that it reprices the market and it reprices it reprices risk in the market. I think it heightens everyone's awareness of this possibility. I agree. I think you can't just have a one-way credit market for 10 years where nothing ever goes wrong, because there's this concept known as the Minsky moment after a famous economist, where when things are too stable, that in and of itself produces its own form of instability. People have to feel like other people are watching what they're doing, and people have to be alert to risks. So I actually think, unless this is the Bear Stearns hedge fund in 2007, and it's the true canary in the coal mine, which, I mean, I won't be the one that will know that in advance. Unless it's that, and I look like an asshole 6 months from today, I don't think that you have to assume that it's that. A lot of people want it to be that. Back to what we were saying about bull markets, all the usual suspects who want there to be another Lehman Brothers, First Brands is their new Lehman Brothers. They have to have it. They need. It's almost sexual.
They want
level
the rich
of desire.
and powerful to be exposed as, see what these guys, why are these guys rich? They don't know anything.
It's grotesque. They're licking their lips. They need this to be the private credit version of Lehman. They want it so bad. So and maybe they'll finally get it. Maybe finally the meteor hit Earth. My God.
I don't know, man. I don't think that Blackstone and Ares and Blue, I don't think all these guys are idiots. Is there too much money there? Or returns going to be lower?
Someone's going to clip that.
Okay, fine. Are returns going to be lower than they were in the past? Probably. There's a lot of money coming in. But is it going to be a absolute destruction of ruin and people going to jail? I don't think so.
You know what's funny about bilateral lending? Like, in game theory, you would assume that to be the safest form of lending. In other words, syndicated loans, we all understand how they go wrong.
That's dangerous, yeah.
It's 1,000 people who barely give a shit, all putting money into the pot. A bilateral loan where I call you and say, okay, I'm going to give you $80 million, but these are the covenants, and if you violate, we're going to court, and I will press you until you either pay me back or I seize your assets or some combination. Wouldn't you just, like, on the surface, be like, all right, these probably aren't all First Brands. Probably most of this activity is not dumb. Some of it, maybe.
If you're making that assumption, you're dumb.
Right. It's like, oh, I gave this guy an entire loan and I had no expectation of getting paid back. Like, who's doing that right now? Is anyone doing that? Probably not any, probably not Ares. If somebody's doing it, it's not them. Okay. Yeah. I actually am going to call an audible here. We're going to dive into this. Hedge fund. Into this global fund manager survey during the Compound and Friends later this week. We'll do it with our guest because we're at 5:58, and I don't want to. I don't want to skip over it.
I'm very glad you all, because honestly, I don't think it's that interesting. But we can pull out some stuff.
All right, so maybe we'll pretend we were never going to do it at all. All right, you want to make the case?
I do. So I want to make the case that I think it's easy to get distracted. I keep saying this. It's easy to get distracted by the nonsense, the speculative stocks, and become very cynical. Iran, Oklo, all of these names would be like, it's a freaking bubble, and maybe that part of the market is, and it probably is, and see the hyperscalers and think like there's nowhere to make money. And that's just not the case. You might be shocked to know that a third of the market is in a 20% drawdown from its 52-week high.
Right now?
A third of the S&P. There's a lot of areas that have opportunity. A third of the S&P 500, 1/3 is 20% or below its 52-week high. Throw this chart up from Matt. Matt charted the median stock, the 52-week drawdown from the median stock. On Friday, that was 13%.
Interesting.
So
this
flies
in the face of this flies right in the face of the bubble narrative.
There's opportunities.
Like, how is this a bubble if the median stock is in a 13% drawdown from the high?
Right.
Like what? So, okay. Bubble.
So, show the Russell 2000. Let's skip here. The Russell 2000 has been sideways since the peak in 2021. It is only now breaking out, and the longer the base, the higher in space. That's Louise Yamada via JC. JC loves to quote that one. I think this one's going a lot higher. But the one that I want to shout out, it's a stock that I don't own. I've owned it in the past. I was listening to Delta. Delta stock is it's 11% off its highs. And the company is crushing it. Free cash flow at an all-time high. And the story with Delta is very interesting. Chart off, please. Did you know that 60% of the industry profits are now generated by Delta? It is eating everybody's lunch. It is the only premium brand in the sky. Hard stop.
Well, I'm very sorry to inform you that we booked American Airlines for our trip to DC in a couple weeks. Delta is always the best customer experience overall, I would say.
By far.
And
I was surprised.
and with an airline, like that's the bar is low, but they do it. I'm happy when I fly Delta.
Corporate travel is higher than pre-COVID highs, which shocked the shit out of me. They're just winning. They're doing everything right. They're firing on all cylinders, and I think the stock is grossly underpriced. And airlines historically have sucked. Love multiple shitty companies, but this is different. I think it's going a lot higher, and I should own it. I don't.
I like it. I think you'll have a crack at it. These are just high beta, sloppy charts. Like, I think you buy a name like Delta when they wreck the overall stock market, and it just succumbs.
I think that's right. I think that's right.
This is not gonna double while you watch it and say, "I wish I owned it." It's just not gonna happen. I mean, just look at you know what I mean? Like, it's just
it's an airline. It's not going to double in a year.
You'll be fine. You'll be fine. But I like it, and I agree with you. If you are invested in anything travel related, this is as good a name as any other. So I do like it. Mystery chart time. I feel good about your chances today.
I feel great.
Okay, these are two different investable assets. They're related to each other. And I think the main point that I'm bringing out is what's gone on over the last 2 weeks.
Okay, so are these semiconductors?
They are not. They're not They're not companies. I specifically went out of my way to say that they are investable assets.
Investable assets. Okay, so I see a lot of okay.
Do it for me. Do it. Come on, you got this. One more hint.
Is it Bitcoin and ETH?
Look at you. Look at you. Super impressive. I'll tell you what I find interesting here. A couple of things. Bloomberg has this really great article about what went on last weekend. Kind of had like a flash crash.
There was a flash crash. Absolutely.
Yeah. So I just want to read this really quickly. For a few manic hours on Friday, the world of digital assets replayed Wall Street's oldest reflex at machine speed during market stress, a stampede for the exits. The spark was familiar but unexpected. Donald Trump's 100% tariffs. The pain was most acute in crypto, with an index tracking altcoins dropping 40% in minutes.
Yeah,
dude, that's nuts.
It was gnarly.
While the crash was brief and prices have partially recovered, critics point to underlying issues in the crypto market structure, makes it prone to violent sell-offs. Quote, during this crash, depth evaporated and liquidation engines got overwhelmed. This is like a crypto expert. Auto deleveraging control mechanisms at exchanges poured gasoline on the fire, and it felt like a market and less like a market and more like a trap snapping shut. Bullish?
It wasn't really Bitcoin per se. It was Sol, I think, fell like 25. Sol and ETH fell 20+%, but it was really the altcoins. A lot of these ones went down 80, 90%, and just to their point, just an absolute air pocket, no liquidity whatsoever. It's pretty ugly.
CoinGlass estimated that a total $19 billion worth of positions were wiped out across trading venues. The actual total is likely much higher, since Binance only reports one liquidation order per second. I mean, listen, a lot of people, it's not good enough that they're taking the risk of being in these things. They also need leverage on them, or they have options and futures trades on them. It's like, it's the biggest casino on earth.
It's so insane. I was saying to Ben today, somebody tweeted, long-term capital management blew up. They were trading fixed income arbitrage. Okay?
Treasuries.
So these are basic points, and they were using 25 times leverage. So what are you doing using 50 times leverage on?
It's just this generational nihilism where it's like, I will never make it in life just doing my stupid 9-to-5 job. Like, I have to.
No, it's not. It's not good. It's not good.
I have to do this.
It's not good. And I'm not a monster. I know there's a whole lot of people that like no crying in the casino, and I agree. No crying in the casino. But I do feel bad when people get wiped out. I'm not happy when I see people losing money, even if even if they should know better. And hopefully the silver lining is some people learn some lesson from this, but it's ugly. It's not great.
LOL.
It's
Nobody
not good.
learns. We have one more chart. This is from Chart Kid Matt. Bitcoin has seen shallower pullbacks versus ETH. That's about what you'd expect, but he illustrated it for us. This chart on the left, the blue is the Bitcoin pullback, and the red line across is the average. The chart on the right, you could see these Ethereum pullbacks are like every time is a crash.
That's heavy. Interesting though, because prior to like 2 years ago, Bitcoin would have been down 30% too in 24 hours.
That's why Bitcoin is like matured. People aren't as quick on the trigger with that thing as they used to be. So that I thought that was notable. All right, great job guessing the mystery chart. Guys, thank you so much for tuning into the live show. We appreciate all our pounders in the audience. You guys are literally the best. We miss you when we're not here. We love you very much. Please tune in tomorrow. All new Animal Spirits with Michael and Ben dropping in the morning. Video out as well. I'm going to start on Ask the Compound later in the day tomorrow. Ben has me on as his special guest with Duncan, and we're going to have some fun. I got a peek at the questions that we're answering. I love doing Ask the Compound, so that's happening. And then at the end of the week, it's an all-new Compound and Friends with a new guest, friend of mine. Super excited to have this person on the show, and you guys will love it. So thanks so much for everything. We'll talk to you soon. Good night.